Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Mark Marex, Director of Index Research and Development with Nasdaq Investment Intelligence, for an update on Nasdaq 100 technicals. Mark, it's great to see you as always. Welcome back to Trade Talks, and let's kick it off taking a look at RSI.
Thanks, Joe. Good to be with you as always. Let's talk about it. Obviously, the index got off to a pretty nice start in January and even early February. Has been running into some weakness and maybe some resistance this week. Relative strength kind of tells us is the sentiment, is the activity in the index getting overly bullish or overly bearish at times. That's the green line that you see going across horizontally, denoting an RSI level of 70, and the red is the RSI level of 30. You pop below 30, that's kind of overly bearish. You could see we did pop below 30 about a year ago, and there haven't been too many other times in the history of this chart, which goes back almost 6 years, right, where we popped below 30. So we know that last year's drawdown in the first quarter was very, very kind of painful and prolonged. That's kind of an outlier here in terms of, hitting that RSI bullish level of 70. It took us a while to sort of really start that downdraft last year when we came into it a little bit hot. This year, you can see, we did peak a little bit above 70, about looks like 73, 74, maybe a week or so ago. And now we've gone right back down to just about the midpoint of 50. So sentiment, no longer kind of being overly bearish or overly bullish. That should probably start to help in terms of, cushioning against some of this downward pressure that we've seen before. We've seen this several times over the past 5 or 6 years, where as soon as you kind of get up over 70, you plunge quickly back down, you get a quick, sharp pullback, but then that helps you kind of consolidate and build the next leg up. So that's certainly the hope here.
Right, and certainly does fit the narrative of more range-bound trade through at least the second, third quarter. So, Mark, when we think about investing, of course, time frames matters a lot. Let's take a look at the moving averages, starting with the short term.
Yeah, so short-term moving averages, we got the 20-day and the 50-day here. And what I've highlighted here is, a couple things, right? The first one all the way on the left, that was the COVID mini bear market, where we, really sunk quickly below both of those short-term moving average kind of support levels. You saw the 20-day crossed under the 50-day, and sort of right after that, you got a bit of a rebound, and then you had a lot of support from that 50-day over the next few kind of circled areas there, as the market continued to recover over the next, call it, 1.5 to 2 years. The 50-day really was pretty good support. What started to happen last year, though, of course, is, you drop below both the 20 and the 50, and the 20 kind of dropped below the 50, oscillated back up a few times, dropped back below a few times. To me, what that means is, most recently when we jumped above both levels again, and you saw the 20 cross above the 50, that's not necessarily the strongest type of support as you might have thought in the past, right? We're still kind of in this bearish longer term downtrend. So while it's certainly, interesting to pay attention to the short-term averages, maybe a little bit less indicative of kind of short-term strength than it has been in the past. That's why we look at others.
Right. Yeah. So with that said, let's take a look at the long-term average.
Yeah. So here you've got 100-day and 200-day. You can see that, for a really long time, right, starting again with that COVID drop on the left-hand side of the chart, the 100-day was above the 200-day. And you had a lot of kind of quick bounces where the index would test the 100-day and then it would jump right back up. That all kind of fell apart at the beginning of last year. And the 100-day actually started to become resistance on the upside, right? You tried to pass above it again, and you fail kind of multiple times. Maybe one time you passed above it, but you never managed to pass above the 200-day. Now, what happened in January and early February of this year is we were able to break above both the 100 and the 200-day. So even though the long-term trend isn't isn't back to where where we'd be in a kind of longer term bullish channel, let's say, with the 100-day line being above the 200-day. The fact that you broke above both of those individually means you do kind of have these two levels of longer term support now, right? The 100-day being right around 12,000, and we did kind of bounce off of that earlier this week. And then the 100-day is a little bit below that. I want to say 11.7, more or less around that level. So bit of support here from the longer term moving averages, I would say, in the short term. And like you said, assuming we're range bound, maybe it'll take some time for that 100-day to pop back above the 200-day, but at least it's giving us some support in the short term.
And finally, Mark, let's take a look at options positioning.
Yeah, so this is a really interesting one to look at in terms of the options put call ratio. The 1 week rolling average is what I'm showing here, back to 2015. This is for the entire U.S. equity market, not just the Nasdaq 100. You could see we were trending kind of downward, right? Fewer and fewer puts relative to calls for a long time, up until, again, about the end of last year. That's when we broke above that trend line, and we've been above it pretty much the whole time. And look at that incredible spike going into year end of last year, right? We got up to almost 1.5 puts for every call in the U.S. equity market. That just tells you how dislodged sentiment got, how overly negative and bearish the sentiment got going into year end. Everyone pretty much was expecting just a kind of continuation of the bear market and not expecting a recovery in the first quarter of this year. That on its own should have been sort of an indicator to folks that maybe contrarian expectations for a short-term rebound were kind of a better risk-reward play, right? And then on the right-hand side, when you look at the volatility, and this is back to Nasdaq 100 only, again, we're kind of starting right around the COVID times. That was that peak of almost 80, and then the level I've highlighted is the VolQ index of about 40. We've tested 40 several times over the past few years. We've come close to it. We've never exceeded it, and we've actually been in a pretty nice decreasing volatility regime over the past couple of months, even though, again, we're having some rough days this week. We're having some pullbacks, maybe some consolidation and a short-term correction. But as long as the volatility stays fairly contained in that level of, the 20s somewhere, low to mid 20s, and you've got not overly bullish positioning in terms of calls versus puts in terms of the RSI, and you've got that support from the longer term moving averages, maybe we can start, building a bit of a base here for this year, and potentially start to reverse some of the losses that we saw in 2022.
All right. Great analysis as always, Mark. Appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.